Hello everybody. So this video is entitled MSTR and Bitcoin. Did you get shaken out? Question mark investigatory emoji. And I want to talk about debt. I want to talk about mark-to-market debt. I want to talk about leverage. And I want to talk about strategy in this video. So let's talk about the wipeout risk. Of course, wipeout risk happens when you take on debt to speculate. Saylor, of course, tweeting to his shareholders and probably tweeting to followers of Bitcoin, talking about volatility being a gift, talking about the rules of Bitcoin to buy Bitcoin and never sell the Bitcoin. Now, of course, volatility is a gift to whoever doesn't have mark-to-market debt. If you don't have mark-to-market debt, you likely will not sell the Bitcoin because you will not be forced to sell the Bitcoin. Now, what happened today, intraday, around 1 p.m. Central Time for me, sure seemed like a mass panic. So what happened around 1 p.m. Central Time? Well, market makers got the price down by about 5% from 77-ish or 78-ish. I think it was 78,500 at the open or something like that. So they took the price down by 5%. Now, it turns out, not understanding the difference between mark-to-market leverage and amplification like the MicroStrategy does is the strategy of the Bitcoin newbie. It's the strategy of the newcomer to the Bitcoin space. What they do is they perp. They go on platforms like Hyperliquid or Jupiter and they're like, okay, 77 is the bottom. Let me 20x. Let me 20x the return and go long. And you go long, right? What do? You go long. You say, okay, I'm going to take 20x leverage at 77K. It's going to go up another 5%. Boom, I double my money. Except the problem is, these platforms, it's public. Whenever you go 20x, for example, on Binance, you go long 20x on Binance, Binance sees that you've been going 20x. They see all of these bets. And so you become a target for them to liquidate you and take all of your money, right? And so this is what keeps happening every time. People think 77 is the bottom. It's not going to go any lower. Social media, that doesn't help because a lot of very prominent social media influencers all said 77 is the bottom, right? My last video, was it 2 or 3 videos ago, I said, I have no idea where it's headed. I have no idea where it's headed. If you use some sort of technical analysis and you think where the bottom is, I have no idea. But I know that if enough people at 77 placed bet that it was the bottom, and these bets are public, everybody can see whatever market maker is going to do. They're going to drop the price another 5% to liquidate those longs and entirely take the funds. And what they liquidated, if you look, again, we're seeing on X today, it's about 500 billion. 500 billion. Midday liquidations were at 285 million. So it's 500 million, half a billion, 500 million. And, you know, that's a net negative if you ask me. That's $500 million of retail, probably Gen Z, probably degens who are never coming back. That's probably what it is here. So going long with leverage mark-to-market is suicide. Quite frankly, leverage on these assets is the best way to get wiped out. So that's why, hence my question, did you get shaken out? Right? Your only job in the 2020s is to not get shaken out. And remember, you can be shaken out on margin too. You can go too heavy on margin on a brokerage account and also get shaken out. So anyways, folks who are in a hurry to outpace Bitcoin may want to consider MSTR. MSTR, and this is no financial advice, don't do it, right? Listen to the internet. MSTR is going to zero. They're going to have margin call, whatever. But MSTR was designed to be a high-octane Bitcoin. Saylor designed it to be about, over the long run, 1.5 times a correlation with Bitcoin. How does Saylor achieve that? He strips out the volatility of the preferreds, takes that volatility, adds it to the common stock. Such that, let's look at the end of the day. You can see the iShares ETF was down, if you count after hours, roughly 3%, 2.5% to 3%. We were down on iBit, right, on Bitcoin. Stretch was barely down. Stretch was down 0.6 if you had after hours 0.55. So stretch had next to no volatility. Now what about MSTR? MSTR was quite a bit more volatile than Bitcoin today. Volatility on MSTR is probably 1.8 or 1.9. Now it's understandable because 2 days ago, yesterday actually we had next to no volatility. So sometimes it's a little more, sometimes it's a little less. MNAV for strategy is still 1.09. So let's move on and let's talk a little bit about the FUD, about the strategy. Most folks don't understand these keys, the keys to understanding strategy. Most folks don't get it. They don't understand that dilution is accretive even at 1.09. I am the first one to dislike the fact that he stopped diluting us in August, right? When the MNAV was 1.45. But the internet was loud, Saylor listened, he shouldn't have. Now he's not doing that mistake anymore. Dilution at 1.09 is accretive, albeit it's way less accretive than before, but you're still selling $1 for 1.09. Now, a lot of people say, you shouldn't use this MNAV. This MNAV is fake. You should be using basic MNAV, and basic MNAV for strategy is negative 0.9, so he loses money. And I will say to that, only a bear would say that. Only a Bitcoin bear would say that. Because if you are looking at strategy as a Bitcoin bull, and which is what I am, I look at strategy as a Bitcoin bull, then you would be using 1.09. If you were a Bitcoin bull, you would be using 1.09. Because when the converts starts coming due in 2029, what would you believe if you're a Bitcoin bull? If you're a Bitcoin bull, you believe that those converts will equitize. If they equitize, that means the convertible debt, of which there is 8.2 billion, that debt will be paid off via dilution. And of course, you understand that the dilution is done at a premium. In fact, most of the converts were issued at 30% premium from the common stock price when it was issued. So you know that equitization is not debt. Like it's not money that you pay back. It's dilution that pays back that money. And key to understanding strategy is that strategy is a black hole. Strategy gets bigger because of dilution. It is dilution that allows strategy to become as big as it is. It is dilution that has allowed strategy to be the, 60 billion now, to be the $60 billion company, a little less, maybe 50, I don't know, but to be the $50 billion company that strategy is right now. That was only possible thanks to dilution. When other companies starve themselves from capital by giving it back to shareholders in the form of a buyback, i.e. burning the shares, strategy doesn't do that. Strategy is a black hole. It absorbs capital forever, for longer, and tries to grow its size this way. And of course, if we're at 1 MNAV, that would be a neutral strategy to the share owner, but at 1.09, this is not a neutral strategy. This is a positive strategy. And here's another thing that people don't understand. And of course, this has never been done. This was done like 400 years ago, but this has not been done in modern times, which is the preferreds are perpetual. The preferreds never come due. That $8.3 billion of debt right here, it's perpetual. It never ever comes due. It only comes due in the event of a collapse of the company. Now, only a Bitcoin bear would believe that the company is going to collapse. If you are a Bitcoin bear, you should not touch Bitcoin. You should not touch strategy. If you don't think Bitcoin is the money of the future, you should stay away from this stock. And if you think Bitcoin can actually go down to 20K, and if you think it can stay there for years, you should not own this stock either. As far as strategy is concerned, Bitcoin failing means Bitcoin dropping to 20K and staying there for many years. That's what it means to fail for strategy, right? We are a long ways from that. If that happens, strategy will fail. If Bitcoin drops to 20K, strategy will fail. It will have been a bad story. It will have been a bad investment. But this is why, if you know me in my portfolio, I have a lot of Tesla. I have a lot of HIMS. I have plenty of other positions. It would be ill-advised to go all in on either strategy or to go all in on any of the instruments. It would be entirely ill-advised because, you always have a remote risk that Bitcoin fails. But if Bitcoin doesn't fail, this is the numbers you're looking at, right? So I didn't put it in there, of course, but the BTC rating for Stretch, for example, is a 6x. So there's six times more money than there is backing the debt. Think about that. But if you look at the years of the Bitcoin years of dividend coverage, at the current price of 76,000, you have 60 years, 61. Let's call it 61. 61 years of dividend coverage. Strategy has a cash reserve. There's 30 months worth of dividends in the cash reserves. So to me, this company is designed to weather a pretty lengthy storm for Bitcoin. Like, this company can withstand without issue 1 year of a bear market for Bitcoin. It was built for that. It was entirely built for that. So Saylor's not gonna get shaken out. Don't fall too easily for a lot of people telling you, oh, he's gonna get margin call, etc., etc., etc. The way the company is designed, you cannot be margin called. And anyways, this is more theoretical, but I think my viewers understand, but my viewers need to understand the difference between mark-to-market debt and book debt or historical debt, anything that has to do with book accounting. Mark-to-market debt is your margin debt. It is your Perps. It is your 20x leverage on Binance. That's mark-to-market debt. Mark-to-market debt is constantly reassessed. It is reassessed every minute. Right? And the moment you're below whatever LTV you use to borrow that money, you get liquidated or you get a margin call and you have like a day to respond or something like that. Whatever you want to call it, mark-to-market debt is very risky because you can lose your entire investment even if the market stays down for like an hour or a few minutes for that matter. That was 10-10. Right, 10-10 was down just a few minutes. That was enough to liquidate a bunch of traders who were mark-to-market. But you see, non-mark-to-market debt is the good debt. It is what I guess I could call it the La La Land debt. And of course, Saylor has created even next level type of debt. He has created perpetual debt where it never comes due as long as you pay the dividends. And even for some of the perpetuals, he doesn't have to pay the dividend. He can skip them. He can skip the dividend for some of the perpetuals that he has created. So it's mind-boggling. It's genius. But if you look, let's take the example in real life. Like let's take an example of good debt. So let's imagine somebody, they borrow $900,000 and they buy a $1 million house in Austin, Texas in 2021. Let's say late 2021. In September 2021, you buy a $1 million house in Austin, Texas. You borrow $900,000. What happened today? How much is that house worth today? Probably 500 if you're lucky. Probably 500,000 if you're lucky. Okay, you're underwater 400K. Does the bank call to get their money back? This is non-MTM debt. This is non-mark-to-market debt. The bank is not calling to get their money back. The bank keeps living in fantasy land, thinking the house is still worth $1 million, even though you would not get that on the market. And as long as the homeowner keeps making the payments, they will not get called. They will not get called out. This is non-mark-to-market debt. This is very similar to the perpetual that Strategy has issued, where as long as the dividends get paid, he will not get called out. There is no margin, right? And so, of course, Austin real estate, that could rebound, but I don't think that's as big of a risk for Austin real estate, especially if you have a 30-year mortgage. Give it 10 years, it's going to rebound, right? But one of the key questions you got to ask yourself, of course, is what about things like office buildings or big GMC trucks? I always call the attention of my viewers to GM Financial. I know people like to invest in auto stocks. Look at GM. Ask yourself, would you want to have that debt? What about goodwill, right? What about an overpriced acquisition? So anyways, mark-to-market valuation is living in La La Land, and it's sometimes a house of cards. And the key to keeping the house of cards going is to not mark-to-market it. And this debt, you see, the real estate debt to buy a house that may drop 50% in value, it is debt that was designed to not be margined, right? The banking system has designed certain debts out there to not be marginable. Saylor did exactly that with its own company, non-marginable. That's a major, major difference from using a perk or using a perp or using margin on a broker. So hopefully that makes some sense, what I'm trying to get at with this video. Hopefully it makes some sense and helps you understand kind of like where strategy is. And so answer the question, did you get shaken out? Well, if you own common in MSTR, no debt, you didn't get shaken out. But unfortunately, the market makers are here to shake you out. They can't do that with real estate. It would be a house of cards. It would collapse if they did that for real estate. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you're entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.